Hello, and welcome to today's webinar, Exploring PSAB's Reporting Model Exposure Draft. My name is Antonella, one of the principals responsible for the concepts underlying Financial Performance Project, and I am pleased to welcome you to today's webinar. I will be your moderator for today's session. I will walk you through some housekeeping items, introduce the speakers, make some introductory comments, possibly ask a few questions throughout the webinar, and come back to you at the end of the formal part of the webinar to work through the Q&A session. So let's start with the housekeeping items. If you have a question, please use the Q&A function. We will address the questions in an appropriate order, either during the presentation or during the Q&A portion of the webinar, depending on the question that is being asked. And now, it is my great pleasure to introduce today's speakers, Nikki Young and Martha Jones-Denning. Nikki, a professor emerita of accounting at St. Mary's University in Halifax, has taught financial accounting and reporting issues for many years and has received numerous teaching awards for her work. She is the co-author of 5 editions of the most widely used Canadian intermediate accounting text. Nikki has also been involved with the Public Sector Accounting Board and its task forces for more than 25 years. In fact, she is the chair of the Concepts Underlying Financial Performance Task Force, the task force responsible for the conceptual framework and reporting model exposure draft. Joining her is Martha Jones-Denning, a long-time principal with the Public Sector Accounting Board, and she is also one of the principals responsible for this project. During today's presentation, we will provide a brief project background and then focus on the key proposals in the exposure draft for a financial statement presentation standard, with an emphasis on what is new in the exposure draft in relation to the previous documents for comment. Then we will discuss the various effects of the proposals, including how you are impacted by the proposals. And as mentioned, there will be time for questions at the end. We do want to mention that there is a lot we could say. However, we know that everyone is busy, so we will focus on the more important proposals. The slide deck includes slides that speak for themselves, and so these are not covered in great detail. However, you do have access to the slides through the webinar's landing page. That's the same web page that you used to register for this particular webinar. Now, before we get into the details, we want to first acknowledge the concepts underlying Financial Performance Task Force that has been instrumental in developing a revised conceptual framework and reporting model on behalf of PSAB. The task force is led by Nikki, one of our speakers today. You can see that each member represents a different PSAB stakeholder group. Each member brings to the table incredible knowledge and experience that has contributed greatly to the development of the proposals for what we believe is a comprehensive, understandable, and high-quality revised conceptual framework and reporting model for the Canadian public sector. And we hope you agree. And so with that, I will now turn it over to Nikki to take us through the proposals in the exposure draft. Oh, Nikki, you're on mute.
Apologies. Although the webinar today focuses on the proposed reporting model, it's important to note that the financial statement presentation standard includes a few other parts as well that relate to the reporting model. Most notably, the standard includes general presentation principles, which are indicated on this slide. Most of these are carried over from the existing financial statement presentation standard. However, the going concern discussion is new. The board felt that it was important to add this section based on the feedback received on the statement of concepts that requested PSAB broaden the discussion of going concern in the conceptual framework to provide further guidance. PSAB felt that similar to other standard setters, the additional guidance requested is best suited for the financial statement presentation standard rather than the framework. Although the framework does include new text on going concern and the longevity of public sector entities. So let's spend a minute or two on the going concern discussion. The going concern material in the reporting model standard focuses on determining whether the going concern assumption is appropriate. In the new proposals, consideration is given to the type of public sector entity and the type of decision or other event that may lead to an entity ceasing operations. In considering the type of public sector entity, the going concern discussion offers guidance as to considerations relevant to senior governments, local governments, territorial governments, indigenous governments, and government organizations, of course. It's interesting to note that no mention is made of the implications of the pandemic on the going concern assumption. It's just too time specific. However, all items affecting the financial performance of a public sector entity would be considered in determining if the assumption remains appropriate. Now let's look at what I'd say is the largest aspect of the financial statement presentation standard, meeting the financial statement objectives. The financial statement objectives are identified and described in Chapter 6 of the conceptual framework, and they foreshadow what will be reported in financial statements. And the webinar, the Exploring PSAB's Exposure Draft, the conceptual framework for financial reporting in the public sector, addressed the last two objectives, disclosing non-compliance with financial authorities and disclosing risks and uncertainties. As a result, this webinar will focus on the middle three objectives: reporting financial position, reporting changes in financial position, and reporting budget to actual comparison. These three specifically relate to the reporting model. And please note that we will not go through the scope objective, as details related are addressed by other specific standards, such as the government reporting model, the government reporting entity standard in PS 1300.
Thank you, Nikki. I have a quick question for you, if I may.
Mm-hmm.
If someone didn't get a chance to watch the conceptual framework webinar and they are interested in viewing it, can they?
Certainly, absolutely. The webinar was recorded and will be available on the FRAS Canada YouTube channel. You can access the video through the project's webpage. If not, yes, in fact, today it should be up, it has been posted. So this link is provided towards at the end of today's presentation. Before looking at the details, it's important to take a quick look at the journey of how PSAB arrived at the principles for a proposed reporting model. Going back to 2011, the task force issued Consultation Paper 1, and its purpose was to refine and better describe the characteristics of government and other public sector entities. And these characteristics set the groundwork for the development of the proposed concepts and principles based on the realities of the Canadian public sector environment. Consultation Paper 2 was issued in 2012. It articulated and set out the objective of public sector financial reporting, who the primary users would be, and asked for stakeholder views on three possible reporting model approaches. The asset liability based approach was endorsed by a good majority of respondents. Consultation Paper 3 was issued in 2015, and this paper considered the feedback received on Papers 1 and 2 and developed an asset and liability based model, which included a statement of comprehensive financial results. I'm not sure if you remember that one, but the feedback received on it indicated that respondents were a little concerned with the fact that there was too much reported on just one statement. Two bottom lines on one statement, unrealized remeasurements along with regular operating results, and separating out unusual items, which are very difficult to define in the first place, particularly in the public sector. As a result, the reporting model proposed in Consultation Paper 3 was set aside. In 2018, PSAB issued Statement of Principles for a revised reporting model, and that document introduced a reporting model that builds on the existing reporting model in PS 1201 that allows certain revenues and expenses to be reported outside of the surplus or deficit for the period. In that model, PSAB introduced a few other proposals, such as the relocation of the net debt indicator. PSAB received a significant amount of feedback on the Statement of Principles. And from a high-level perspective, it's important to note that the majority of feedback we received actually agreed with the proposals on the Statement of Principles. However, many suggestions were also received for improvements. So PSAB spent a lot of time considering this feedback, as we have every step along the way, and determining how to improve the reporting model. So we'll take you through the key reporting model proposals, including how PSAB responded to the feedback received on the Statement of Principles.
Nikki, before we look at the proposals for a revised reporting model, we have a question related to section PS 1201. You said that the proposed reporting model builds on the reporting model in section PS 1201. It is my understanding that this standard is not yet effective for governments as it is effective on April 1st, 2022. So what is the difference between the reporting model in section PS 1201 and the reporting model currently being used by governments?
Okay, good question, Antonella. PS 1200 that governments currently use, and the difference between it and section 1201 is the introduction of the statement of measurement, remeasurement gains and losses. And this statement is related to the financial instruments suite of standards. This statement reports unrealized remeasurement gains and losses arising from financial instruments and also foreign exchange standards. So let's take a look at the reporting model proposed in the 2021 exposure draft. The key changes proposed to the existing reporting model in section 1201 include the items on the slide. And for those who have followed the project since its inception, I do want to note 5 proposals that are new since the 2018 proposals. First, introducing and defining 2 categories of liabilities: financial liabilities and non-financial liabilities. Amending the definition of non-financial assets. Revising the net debt calculation using the financial and non-financial liability distinction. Eliminating the requirement, only the requirement for the statement of change in net debt from the financial statement package, while still allowing the option for reporters to report the change in the indicator on the new statement of net financial assets or net financial liabilities. And lastly, new budget requirements.
Nikki, before we get into reviewing these proposed changes, I want to tie it back to the slide on the meeting the financial statement objectives. At that slide, you had said that this webinar will focus on the middle 3 objectives: reporting financial position, reporting changes in financial position, and reporting actual to budget comparison. How do these proposals on the slide relate to those 3 objectives?
Thanks, Antonella, for this question. The proposals in the first and second rows all relate to reporting financial position. The first 2 proposals in the last row, removing the statement of change in net debt and introducing the statement of change in net assets, they both relate to reporting changes in financial position. And the very last proposal, the new budget requirements, relates to reporting actual to budget comparisons. It's important to note that this slide only highlights the key proposed changes to the reporting model. However, the proposed model also includes a statement of operations and a statement of cash flows. Both of these relate to reporting changes in financial position. During our presentation, we'll briefly discuss these 2 other statements as well, but the focus will be on the items listed on the slide. The first 5 key changes to the reporting model relate to the statement of financial position. Each major change identified by a separate bullet on the left-hand side of the slide, and on the right side, the illustration, what the financial statement would look like. The relocation of net debt, the restructured statement, and the introduction of the third component of net assets are proposals from the 2018 Statement of Principles that PSAB has retained and improved on based on the feedback received. As mentioned previously, the categorization of liabilities into financial and non-financial and the amended net financial asset definition are new to the exposure draft. And Martha will walk you through each of these individually. So I'll turn the presentation over to Martha now.
Thanks so much, Nikki. The relocation of the net debt indicator is where we'll start. The proposal is to relocate the net debt indicator from the statement of financial position to its own statement. And this is related to the decision to split liabilities into financial and non-financial categories. So a quick review of this proposal first. So PSAB decided to relocate the net debt indicator to its own statement, the statement of net financial assets or net financial liabilities. That's because it allows the indicator to be prominently displayed on its own statement, given its importance, rather than being presented as a subtotal on the statement of financial position. And the entity can focus its narrative on the indicator on that one statement, on the indicator, on the change in it, and explaining the indicator and the relevance of the indicator to its financial position and results. In a few slides, when we look at the statement of net financial assets or net financial liabilities, we'll explore further how the statement allows the indicator to be more understandable. It's important to note that PSAB is not proposing to delete the net debt indicator. There was some perception that moving it, net debt was on its way out, and that's absolutely not the case. Net debt is still required. PSAB believes net debt is an important indicator and is retaining it and giving its own statement. So net debt provides information about future financial resource requirements, those required to settle past commitments and obligations. The extent of an entity's net debt and its financial ability to service its liabilities are important factors in assessing the entity's sustainability. Net debt is a key affordability measure for all public sector entities, regardless of whether they are able to tax or issue debt. The net debt position is created by the entity's past activities, specifically any decisions to incur liabilities, not just issue debt. For example, some entities have large unfunded pension liabilities or material capital leases on capital assets that are integral to their operations. Entities need to know what is required in the future to pay for past commitments and obligations, and so do their stakeholders. It's important to mention this because some of the feedback received by PSAB in the past in response to the Statement of Principles was concern that PSAB was removing the important indicator, and PSAB is absolutely not, as I said earlier. The relocation of the indicator to its own statement is intended to display it more prominently than if it was continued to be reported as a subtotal on the Statement of Financial Position. The introduction of financial and non-financial liabilities is a big change from the 2018 Statement of Principles proposals. The need to ensure that the net debt indicator retained its original meaning of future financial resource requirements led to the need to distinguish between financial and non-financial liabilities on the Statement of Financial Position. Having liabilities separated into two categories removes some liabilities from the calculation of net debt in order to return it to its original meaning, that, as I mentioned, future financial resource requirements. The liabilities that would be removed are those that should not be part of the net debt calculation because they won't be settled using financial assets and they don't create future financial resource requirements. So let's explore this proposal further. A financial liability is a liability that is expected to be settled using financial assets. And most liabilities of a public sector entity will be financial liabilities. Liabilities that meet the definition of a financial liability may include the items listed on the slide. A non-financial liability is a liability that cannot be settled through the use of financial assets, but only through the use of non-financial assets or economic resources that are currently excluded from recognition in financial statements. A non-financial liability does not represent a future financial resource requirement. Liabilities classified as non-financial liabilities are primarily of the three types listed on the slide on the right-hand side. You'll notice that in both financial and non-financial liabilities, we talk about government transfers received. So let's spend some time talking about this. The government transfers standard states that depending on the circumstances, an obligation that meets the definition of a liability may or may not arise in relation to the four scenarios indicated on the left side of the slide. So if you have an obligation because of a transfer received, you first have to determine whether it meets the definition of a liability or not. Once you've made that decision, then it's a classification question. Liabilities arising from an operating transfer are financial liabilities because the entity has received the resources to settle the liability through the transfer. Where it gets interesting is around capital transfers received. So a liability arising from a capital transfer received that is for the purpose solely of buying or building the capital asset is also a financial liability because the entity has received the resources to buy or build the capital asset. As the capital asset is bought or built, the capital transfer is recognized in revenue. A liability arising from a transfer of a tangible capital asset, and I'll give as an example a receipt of one province one province receives a plane to fight forest fires from another province. So they received a tangible capital assets, and that asset is required to be used to provide future services over a certain number of future years. That would be a non-financial liability because the liability is not settled through the use of financial assets. It's settled through use of the asset to provide services. And finally, the last example here is a liability arising from a capital transfer received for the purposes of buying or building a capital asset. And then it also has to be used. It's required through stipulations or otherwise to be used in providing services for a defined number of future years. And that gives rise to both a financial and non-financial liability. So that's more complex. So let's look at that a little more closely. If an entity determines through a review of the arrangement that a capital transfer received remains a liability until the related asset is used to provide services, then the initial liability is a financial liability. This is because the first obligation is to buy or build the tangible capital asset. The entity would settle this obligation by using the financial resources, the transfer received, that it received to buy or build the asset. That financial liability would be reclassified to non-financial liabilities as the asset is bought or built. This reclassification is demonstrated with a journal entry on the slide. The reclassification is required as the remaining liability, if it meets the definition of a liability, would not be settled through the use of financial assets, but rather settled as that tangible capital asset that was bought or built is used to provide future services. Some public sector entities refer to this liability as spent deferred capital contributions or just deferred capital contributions. So I want to take the opportunity to link this result to one of the benefits of the revised net debt calculation that we'll speak to in a few slides. By creating two categories of liabilities, it allows items such as spent deferred capital contributions or deferred capital contributions to be clearly excluded from net debt. Now let's look at the proposal to restructure the statement of financial position. The proposed relocation of the net debt indicator led PSAB to propose a revised structure for the statement of financial position, which was originally designed to facilitate the calculation of the net debt indicator on the face of the statement of financial position. The statement of financial position is proposed to be restructured to present total assets followed by total liabilities to arrive at the net assets or net liabilities indicator of financial position to make the statement more familiar and understandable to users. And then the three components of net financial position are presented. And over to you, Nikki.
Thanks, Martha. Now let's take a look at accumulated other, the proposed new component, the third component of net assets or net liabilities. As a reminder, the existing reporting model in PS 1201 includes two components of net assets or net liabilities: accumulated operating surplus or deficit, and accumulated unrealized remeasurement gains and losses. The new third component will allow PSAB to respond to users' needs as they arise and to transparently reflect the economic substance of unique transactions and other events, leading to improved accountability information to be presented in the financial statements. Now, PSAB evaluated various criteria that could be used to ensure consistent use of this new component. However, it was determined that the criteria were very subjective and it was a very difficult thing to do. So instead, PSAB concluded that in determining that a revenue or expense should be recognized outside of the surplus or deficit for the period when it arises, PSAB underlined, would need to demonstrate in the basis for conclusions of that standard why such recognition provides better information for accountability purposes for users. And this would be a standards level decision, that is, in a particular project for a specific financial statement item. The accumulated other component would be used only in rare circumstances. And only PSAB would be able to designate a revenue or expense to be recognized both in this component and in the accumulated unrealized remeasurement gains and losses component. Extrapolation to other events would not be allowed. The hope is that these parameters would reduce the risk that the component would be overused or misused. The new component is being referred to as accumulated other, and because it's unknown at this time what PSAB will include in it. As standards are developed and if items are identified for inclusion in this component, the name of the component can be revisited. If PSAB concludes that transactions recognized in this new component share certain characteristics, it can subdivide the accumulated other component to establish an additional component that would better describe the aspect of financial position to users. A new component might be appropriate, for example, if PSAB were in the future to require inherited natural capital or heritage resources to be recognized in financial statements. For these items already held by the entity, revenue or liability recognition on the credit side of the transaction may not be appropriate. So the new component allows for consideration of a third option. Now, we'd like to review with you some of the feedback PSAB received in relation to this component in response to the 2018 Statement of Principles.
Nikki, before you go into that, I just want to make sure I understand something. So the accumulated other component cannot be used freely, and it could only be used when a standard states that it can be used for a specific transaction or other event. Is that right?
That is correct. You have it, Antonella. In fact, the notion that only transactions and other events designated by PSAB in specific standards should be recognized directly in the component is stated multiple times in the standard. And the same notion applies to direct recognition in the accumulated remeasurement gains and losses component as well. So now let's look at some of the feedback that we received. Some respondents noted that all revenues and expenses should be reflected in the period surplus or deficit. And such a model is what would be known as a pure asset and liability model. However, the model that we're proposing is an asset and liability based reporting model. Most changes in assets and liabilities that has a net effect on net assets or net liabilities are recognized in surplus or deficit in the period they arise. However, The proposed model would allow certain revenues and expenses to be recognized outside of surplus or deficit in the period in which they arise, but only as directed by PSAB. As I guess we have to underline that and underscore that repeatedly. Recognizing certain revenues and expenses of a period outside of that period surplus or deficit was needed to respond to users' needs as they arise in order to reflect the economic substance of unique transactions and leading to improved accountability information being presented in the financial statements. Accounting theory for an accountability or stewardship-based model, as is proposed by PSAB, further substantiates distinguishing unrealized remeasurements from financial performance arising from replicable operating transactions and activities. This reflects an accountability emphasis on realized performance and recognizes the greater uncertainty associated with unrealized performance. It may also be appropriate in a stewardship-based focused model to justify excluding from surplus or deficit the initial recognition of items that will be held solely for stewardship purposes. For example, heritage items, natural capital, or perhaps endowments restricted in perpetuity. So the need for a new component of net assets or net liabilities. And PSAB is not alone in allowing certain revenues and expenses to be recognized outside of that period surplus or deficit. Other standard setters, notably the international ones, have already created standards allowing certain revenues and expenses to be recognized outside of the surplus or deficit for the period. Some respondents indicate a concern that the accumulated other component would create confusion as it's abstract and not well understood. Creating a reporting model that is understandable is a key factor in determining the most appropriate location for revenues and expenses recognized outside of surplus or deficit in the period they arise. PSAB felt that the proposed reporting model is more understandable than other reporting model options considered, because financial position is made up only of assets and liabilities, of economic resources, economic obligations, and users understand what assets and liabilities are. It does not have deferrals or two bottom line approach, which stakeholders rejected in earlier consultations. And please note that to help understand the reporting model, various illustrative financial statements have been included in the exposure draft. There was some concern expressed that the accumulated other component would reduce transparency. But the board believes that the reporting model is transparent. The newly created statement of changes in net assets and net liabilities, which we'll discuss in a few slides, captures all revenues and all expenses arising in the period. The purpose of the statement is to be transparent with respect to those revenues and expenses recognized in the surplus or deficit and those recognized directly in net assets or net liabilities.
Nikki, before you go to the next slide, does the conceptual framework acknowledge that certain revenues and expenses can be in fact recognized outside of that period surplus or deficit, given that that is what PSAB is proposing in the reporting model?
Absolutely, Antonella. Chapter 6 of the proposed conceptual framework explains the concept supporting the exclusion of some changes in the entity's financial position in a period from surplus or deficit of that period. As a result, the accumulated other component is consistent with the concepts in the proposed conceptual framework. Thank you for the question. Now for a quick walk through the last proposed change, a change that relates to the statement of financial position that was included in the exposure draft, but not included in the statement of principles. The proposal for a revised non-financial asset definition. As you can see from the slide, The proposed definition for a non-financial asset is it's an asset that does not meet the definition of a financial asset. So PSAB decided to propose a new definition because it recognized that there were certain categories of assets, such as intangibles, that did not easily fit into the existing categories. The existing non-financial asset definition was developed back when the primary non-financial asset considered in the model were actually tangible capital assets, and they were just newly recognized in the PSAB handbook at that time. And the wording of the existing definition actually reflected that emphasis. So to allow the reporting model to be long-lasting and inclusive, it was important to improve on the definition to allow for possible recognition of intangible assets and potentially assets that aren't yet on PSAB's radar. Next is the proposed statement of net financial assets or net financial liabilities. This is a new statement introduced in the 2018 Statement of Principles. It presents more prominently the net financial assets or net financial liabilities indicator, currently known as net debt. And we'll address the name change in a few moments, but first I want to focus on the calculation. This indicator is proposed to be financial assets minus financial liabilities, as shown on the slide. The clarification of the liabilities allows the indicator to measure what it was meant to measure: future financial resource requirements or financial assets available to provide future services. So the calculation you see on the slide is new. The 2018 proposal did introduce the statement of net financial assets or net debt. However, the calculation of the indicator was a bit different. First, there wasn't the notion of financial liabilities in that document. Further, there were a number of ins and outs and adjustments in getting to the real net debt number that caused concern for respondents, both in the financial assets and financial liabilities numbers. And that caused concern for respondents. With the proposed split of liabilities into financial and non-financial liabilities, and with clear definitions of the two types, the statement and calculation as proposed to the exposure draft is now cleaner, simpler, and reduces the risk of auditor and preparer debates. You'll also notice from the slide that the new statement also requires presentation of an explanation of the meaning of the indicator directly on the face of the statement. This is so that the indicator can be better understood by users. The last thing we want to mention in relation to this is the option to include a calculation of the change in the indicator. In the 2018 proposals, the requirement to present a statement of change in net debt was removed, as many stakeholders felt that the current reconciliation, the accountant's reconciliation that the statement appeared to be, was not well understood. Although the majority of respondents agreed with the proposal, some put forward very compelling arguments as to why the information regarding the change in the indicator remains valuable. So PSAB decided that if an entity feels that accountability is better served when the change in net debt is explained, the entity can present the reasons why the indicator has changed in the accounting period, perhaps in a similar format to what it presents now in the statement of change in net debt at the bottom of the statement. It wouldn't have to be in the same thing that is now, the same way that it is now presented, but it's an option for explaining it. And the presentation, again, would have to include a budget column as currently exists. In presenting this information, the entity would need to ensure that it is understandable to the user. And presenting all the information on the indicator in one statement may lead to it being better understood and allows for a more comprehensive narrative about the meaning of the indicator and in the entity's own words.
Nikki, at its December meeting, PSAB approved an amendment to the Statement of Change in Net Debt to show the details related to the change in net remeasurement gains and losses. What will happen to this approved amendment with the proposed reporting model, given what you've said? That
The simple answer, Antonella, is that the amendment would be carried forward, carried over to the new proposed reporting model. So this means that if an entity chooses to show what caused the changes in net debt, it can also show the details related to the change caused by remeasurement gains and losses. And I knew that was an issue with a number of organizations. There are benefits to the proposals identified related to the net debt or net financial assets or net financial liabilities, and these are indicated on this slide. This includes the fact that it provides an opportunity to rename the net debt indicator. And for many years, PSAB has heard from so many constituents that it should reconsider renaming the net debt indicator because of confusion with other debt-related numbers reported by government organizations such as issued debt net of sinking funds. So with this approach, PSAB can respond to these comments. To conclude, PSAB is proposing, after considering many options, that net debt be renamed net financial liabilities, with the positive aspect of the indicator continuing to be referred to as net financial assets. So over to you, Martha, for the statement of operations.
Thanks, Nikki. So the slide that you see shows the proposed statement of operations. Statement of operations is virtually unchanged. So I think that's actually a key proposal, that it's unchanged. What's new compared to the 2018 proposals is that clarity has been proposed in relation to the presentation of revenues and expenses. So the existing requirements indicate that financial statements should disclose the gross amounts of revenues and expenses. And that's caused a bit of confusion. Do we mean in the notes, on the face of the statement? What does PSAB mean? So PSAB is providing clarity by indicating that revenues and expenses are to be reported at their gross amount on the face of the financial statements unless required by another standard. And that's key because some standards do require a net presentation. Just note that this proposal may have budget implications for some entities. So this is the proposed statement of changes in net assets or net liabilities. This is a new statement compared to the existing reporting model in section PS 1201, but it is unchanged from the 2018 proposals. It shows the reconciliation between the opening and closing balances of each component of net assets or net liabilities. The purpose of the statement is to be transparent as to those revenues and expenses recognized in surplus or deficit, and those recognized directly in another component of net assets or net liabilities, such as accumulated remeasurements or accumulated other. Note that most revenues and expenses by default will be reflected in the period's surplus or deficit when they arise. Only PSAB can designate a revenue or expense for initial recognition in accumulated other or accumulated remeasurements. Now the statement looks very summarized, and that's because it's a slide. But more detail would be expected in your statements. But I do want to note that this statement does not preclude an entity from also providing a detailed statement or schedule to support the summary information reported in the statement in any particular component, if the details of the changes in that component are too much for the statement of changes in net assets or net liabilities. So, for example, an entity may wish for accountability purposes to provide a statement or schedule of remeasurement gains and losses, and just include summary information for this component on the statement of changes in net assets or net liabilities. Now let's look at the budget proposals. In the statement of principles, PSAB proposed that when the scope of the activities in the budget is not the same as the scope of activities in the financial statements, so that is not all controlled entities that are included in the financial statements are included in the budget, a note would be required on the face of the statement of operations explaining why the actual to budget comparison could not be done. And the intent of the proposal was to eliminate scope reconciliations that were not understandable, consistent with the need an accountability objective to provide understandable information to users. But some respondents indicated that this proposal went too far. It reduced the accountability value of financial statements because the actual to budget comparisons are so important to closing the accountability cycle in the public sector. So PSAB considered this feedback seriously and concluded it should narrow the circumstances in which a note would be required on the statement of operations, because it does feel strongly that it is in the public interest to provide an actual to budget comparison on the statement of operations wherever possible. So in order to do so, in order to provide the actual to budget comparison when there's a scope issue, a reporting entity may need to show a reconciliation with scope adjustments in the notes. The scope adjustments would need to add to the approved consolidated budget of the entity, the approved budgets of any controlled entities whose budgets were not included in the approved consolidated budget for the entity. However, if the reporting entity does not have an approved budget for a controlled entity that is consolidated for financial statement purposes, and that entity is material, then the actual to budget comparison cannot be done. In this case, you can't create a budget for an entity that didn't exist. So in this case, a note would be required on the face of the statement of operations as to why the actual to budget comparison could not be done. In summary, the budget amounts on the financial statements should be presented using the same basis of accounting, same principles, same scope of activities, and the same classification as the actual amounts reported in the financial statements. This allows for an understandable actual to budget comparison. When the basis of accounting or accounting principles or scope or classifications, any or all of the above, used in the budget are different from what is used in preparing the financial statement, the budget amounts would need to be restated. The restated amounts would be identified and reported as restated amounts on the face of the statement of operations. And note disclosure or schedule would reconcile the restated budget numbers back to those approved in the original budget. When budget information is not prepared or approved, an acknowledgement stating this fact should be presented. This acknowledgement should also explain why the actual to budget comparison could not be done. The budget is a key piece of the accountability cycle, as mentioned previously, and as a result, it is important to note when a budget is not prepared or approved and why. Before ending the budget discussion, we want to mention the proposals regarding when an amended budget can be used. In the 2018 proposals, PSAB specified 3 circumstances in which an amended budget could be used, 1 for government and 2 for government organizations. Some respondents expressed concern with permitting the use of an amended budget when a government organization experiences significant change in the period. They noted that the situation was too broad and could result in many scenarios, thereby reducing the accountability value of the financial statements. And PSAB agreed. It's for this reason that PSAB has removed that 3rd scenario and is proposing only to allow the use of an amended budget when there has been a decision by the public to change governance, such as when an election has been held. The idea behind that being that the purpose of financial statements is to provide accountability to the public and its elected or appointed representatives. And when the public decides to change those representatives and their mandate, the use of an amended budget may be appropriate. Similarly, an amended budget may be presented by a government organization only when the majority of its governing body has been newly elected or appointed and it has approved a new budget. The use and reasoning for using an amended budget would need to be disclosed. To help different types of public sector entities see themselves in the proposed reporting model, 5 illustrative sets of financial statements are included in the exposure draft, one for each type of the entities reflected on the slide. Essentially, there's a lot of similarity between the illustrative financial statement packages, but there are certain transactions that have not been reflected in every illustration because PSAB felt they didn't apply to all entities. Although PSAB has not designated any transactions for recognition in the accumulated other component of net assets or net liabilities, this component was added in the illustrations to show that PSAB is being responsive to the feedback received on previous documents and to the needs of users. The example being presented is a possible, and I emphasize possible, presentation option for endowments. There are no proposals for accounting for endowments in the reporting model proposals. This is just an example. It's included to show stakeholders that the proposed model would give PSAB a new alternative to consider in order to report the substance of endowment contributions. So that brings us to a conclusion in relation to the key reporting model proposals. PSAB believes that the proposed reporting model is responsive and responsible. It is rooted in the notion of accountability and what is in the public interest. And I'll note that the accountability lens is what PSAB used for all of the proposals in both the conceptual framework and reporting models. The proposals considered all public sector entities and the needs of their stakeholders, and PSAB believes they have considered all the feedback received to all of the previous documents for comment. Now let's review the effects of the proposed financial statement presentation standard. The proposals are supposed to be effective for fiscal years beginning on or after April 1, 2024. That's the plan now. In selecting a transition period, PSAB noted that because its proposals only affect presentation, they should be more straightforward to implement than changes affecting recognition and measurement. So the board looks forward to your thoughts on that, whether the proposed 18-month transition period from the date it's included in the Public Sector Accounting Handbook allows sufficient time for entities to make necessary system updates, collect the information needed to restate comparatives, and resolve any operational challenges. So please let us know about that effective date. The proposals affect the presentation of financial statements. So preparers may need to update their financial systems and processes to reflect the revised financial statement presentation. For financial statement users, the proposals aim to improve how information is presented in financial statements and thus improve the quality of financial reporting by providing understandable information about financial position and net financial assets or net financial liabilities, net debt, and by improving the transparency about those revenues and expenses that would be reflected both in and outside of a period's surplus or deficit. In previous announcements, PSAB noted that in relation to setting future standards, it would continue to apply its own conceptual framework and reporting model. As a result, we thought it would be important to give you a review comparison of the PSAB's reporting model and PSAB's proposed reporting model. As you can see from the slide, there are a few minor differences in relation to all of the statements. For example, in the statement of financial position, the PSAB requires the presentation of assets and liabilities in current and non-current categories, whereas PSAB's required presentation is financial and non-financial. The presentation of financial and non-financial helps determine the net financial liabilities, also known as net debt indicator. The PSAB doesn't require the presentation of this indicator, and so it doesn't have a statement of net financial assets or net financial liabilities. So what do these differences mean? Essentially, when PSAB sets future standards for specific assets or liabilities and it's leveraging the principles of a particular IPSAS, it would need to provide additional guidance as to whether the asset or liability was financial or non-financial, and the implications for the statement of net financial assets or net financial liabilities. If you're interested in more details regarding how the differences will affect the setting of future standards, there will be a new publication coming out soon where we do exactly that. We go through the differences both for the conceptual framework and the reporting model between PSAB's proposals and what the PSAB has, and talk about the implications for future standard setting. So stay tuned in the next week or so, that should be published. We've talked about the proposed reporting model and that it will have an impact on users, preparers, and future standard setting. But we also want to note that there will be a series of consequential amendments proposed to the Public Sector Accounting Handbook as a result of the proposed reporting model. Essentially, these consequential amendments are being proposed to ensure that there's consistency throughout the Public Sector Accounting Handbook. They're in a separate summary exposure draft that accompanies the reporting model exposure draft, and they relate to the items listed on the slide. There is a detailed supporting document that if you wanted to look at the very specific granular changes to each standard throughout the handbook, there is a supporting detailed document that you can look at. Some of the consequential amendments are editorial in nature. Most of them will change practice in relation to the presentation of financial statements. PSAB expects to issue the final consequential amendments after it finalizes the new financial statement presentation standard. And the proposed amendments will be effective at the same time as the new financial statement presentation standard. And back to you, Antonella.
Thank you, Martha and Nikki. Before we get to the Q&A session, we would like just to take a few seconds to talk about next steps. And I'm going to try to talk as fast as I possibly could because I realize it's almost 1 o'clock. But essentially, the very next step is being PSAB's goal to set accounting standards together with its stakeholders. PSAB is very interested in your views. PSAB values your input. Your feedback on past documents has been much appreciated. And as this is the final phase of the due process, we are interested in knowing whether there are major areas you think are problematic. You're encouraged to submit your thoughts either by submitting a comment letter or by visiting our community platform at connect.frascanada.ca. Our new community platform is a quick and easy way to submit your thoughts. Now, we recognize that we've talked about many proposals. There is a lot to take in. We have developed a series of documents to help you through those proposals. A link to those documents is on this particular slide, and you have access to all the slides on the webinar's landing page, which is where you were able to register for this particular webinar. So now we've arrived at the Q&A session of this webinar. We do have quite a few questions that have come in, and I recognize that we have only a minute left, so I'm going to try to ask at least the first question. Martha, you stated that PSAB is not reviewing the requirement for the statement of net debt. However, on page 8 of the in-brief document, so first of all, thank you for reading our in-brief document, PSAB has the heading optional presentation, and the first sentence states PSAB proposed to discontinue the requirement to present a statement of change in net debt. Accordingly, PSAB decided that the presentation would be optional. So in relation to that, there's a sort of a secondary question asked by the same individual that says, how is making an indicator or statement optional not removing the requirement? Martha, I don't know if you wanted to get to that.
Yeah, I'll try to answer quickly. So the statement of change in net debt is no longer proposed as a required statement in the financial statement package. However, given the input that PSAB received, that for some entities in particular, and I'll mention senior governments in particular, they felt that retaining the information that they currently report in the statement of change in net debt is important accountability information. So PSAB wanted to allow the option to continue to report that information if an entity wants to, but it wants all of the information on net debt to be on the one statement, which is the statement of net financial assets or net financial liabilities. And so it's an option. You don't have to report the change in net debt on that statement, but if you do wish to report the change in net debt, that's where you would report it. Hopefully I've answered the question.
I think so. I'm going to quickly sort of get to the second question we received, which is, are derivatives meant to be included in the new net debt calculation? Nikki, I don't.
That was a question that did come up along the way. Derivatives have to go through the sequence of decisions. Derivatives, first of all, whether they are financial assets and can be used to meet future liabilities, or whether they are restricted in somehow. If they're restricted, say, as part of an endowment, that they're in an endowment and the principle of the endowment can't be used for, it is restricted in how it can be used, then it could well be reported as a non-financial asset within an endowment. So there's two, it has to both meet the definition of asset and a financial asset. And those decisions have to be taken in sequence.
Yeah. I mean, I think we concluded that most derivatives would be financial assets and financial liabilities. The only wrinkle we could think of was endowments, but I will acknowledge that someone on the Conceptual Framework webinar on Monday did raise a question that we're going to have a bit of a think about on a similar question.
So just for everybody listening in and still tuning in with us, I'm sort of just going to, I'm very respectful of your time, and I realize that it is 1:02. And so what we're going to do is we're going to take the webinar to 1:05, maybe answer one more question. So if you'll stick with us till 1:05, all other questions that we haven't been able to answer, we will answer, we will get back to the individuals that have asked the questions themselves, and we'll think about whether some of the questions can be made public through one of our platforms. But just to get us to the next question, since the changes to the financial asset definition were editorial, and the definition of a non-financial asset, although new, is an asset that does not meet the definition of financial assets, would it be appropriate to assume that in practice, what is included as a financial asset and a non-financial asset should not change with the proposals in Section PS 1202?
So I think with the existing assets that are allowed to be recognized, that you probably wouldn't change how you're recognizing an asset as financial or non-financial asset now, but there may be new items in the future that will meet the definition of non-financial assets that you don't currently recognize, such as developed or inherited intangibles, which aren't currently excluded from recognition. So it could be that new standards that PSAB brings on board in the future will require the recognition of new non-financial assets, but I don't think the changes to the definitions would change how you recognize the assets that you currently recognize.
Okay, well, thank you. Having seen that it's 1:04, I think to be respectful of everybody's time, I do want to thank you for tuning into this webinar. Thank you, Martha. Thank you, Nikki. Like I said, we received a lot of questions, so thank you for all those questions. We will get back to each individual with an answer to your question or a comment. I see some of the questions or comments, but we can't thank you enough for tuning in. We look forward to hearing your thoughts. If you do have any more questions, please feel free to either contact us or visit our connect.frescanada.ca community platform, where you can ask questions and we'll answer them. Thank you again, and we wish you all a wonderful day.
Thank you.
Thank you.